Required minimum distributions, otherwise known as RMDs, can be a confusing topic for many retirees. As a financial planner, I've seen numerous individuals make mistakes when it comes to managing their RMDs. Today, I'll break down the top 10 most common RMD mistakes. I'll give you the info you need to navigate this complex part of your retirement plan. Hey everyone. My name is Danny Gudorf with Gudorf Financial Group, and I'm here to teach you what you need to know to create a limitless retirement. So let's go ahead and jump in. The first mistake I see is a simple one, but it's surprisingly common. The first one is not starting your RMD on time. The rules for starting RMDs have changed, and they have changed often with the new Secure Act 2.0 legislation. This has led to some confusion. In the past, the starting age for RMDs was 70 and a half. However, it now stands at 73, and it's set to change again to age 75 in the future. To make this easier to understand, let's take a look at an example. If you were born in 1951, you will turn 73 this year in 2024, which means it's time for you to start taking your RMD. The starting age of 73 applies to anyone born between 1951 and 1959. If you were born in 1960 or later, your RMD starting age is currently set to 75 years old. However, it's important to note that this could change again in the future before this is even actually implemented. But for now, the RMD starting age is 73 until the year 2033, when it's scheduled to increase to 75. It's crucial to start your RMD on time to avoid potential penalties. The IRS imposes hefty fines for failing to take your RMDs as required. We'll discuss the consequences of missing RMDs in more detail later in this video. The second mistake I often see is combining RMDs with a spouse. Many people assume that because they file their taxes jointly, that they can also combine their RMDs together. However, this is not the case. RMDs are an individual responsibility, not a joint one. Each person's RMD is calculated based upon their own individual age and the value of their retirement accounts. Even if you're married, you and your spouse must satisfy your RMD requirements separately. You cannot take the entire RMD amount from one spouse's account and consider it fulfilled for both of you. It's very important to understand that each individual is responsible for their own RMD regardless of how you file your taxes. The third mistake is misunderstanding the potential cost of not starting your RMDs on time. As I mentioned earlier, you must take your first RMD by age 73. However, there is a loophole that allows you to delay your first RMD until April 1st of the following year. While this may seem like an attractive option, it comes with a significant drawback. If you choose to delay your first RMD until the calendar year after you turn 73, you will still be required to take out the second RMD in the same year at age 74. Essentially, what you would be doing is doubling up your RMDs in that first year. Now, doubling your RMDs means potentially doubling the income tax that you'll owe on those distributions. In some cases, it could even push you into a higher tax bracket, resulting in an even greater tax burden. Normally, unless you have a rare situation where you expect your income to be much lower in that next year, you should always take your first RMD at age 73. This will let you avoid those higher taxes. The fourth mistake that I often see is confusing RMDs with Roth conversions. We all know how powerful Roth conversion planning can be. If you're a regular viewer of this channel, you know that I'm a big fan of Roth conversions. However, it's important to understand that RMDs cannot be converted directly into a Roth account. When you take your RMD, the money must be separated from your account and taxed as ordinary income. You cannot take your RMD and then convert that specific money into a Roth account. That being said, you can still do Roth conversions while you're receiving your RMDs. But you first must satisfy your RMD. Then after taking your RMD and paying the tax, then you can choose to convert more money from your traditional IRA into your Roth IRA if that's something that makes sense for you. The fifth mistake is misunderstanding the RMD aggregation rules for IRAs. And this is one that a lot of clients get confused on. If you have multiple IRA accounts subject to RMDs, you have some flexibility in how you decide to take those RMD distributions. You are not required to take a separate RMD from each individual IRA account. Instead, you can calculate the total RMD from the sum of all of your IRAs that you have. Then you can choose to take the whole distribution from one or more of those accounts if you choose. As long as you withdraw the total RMD amount, you have satisfied the requirement. This creates a great planning opportunity if you want to be strategic about which accounts you take your RMDs from. For example, if the market is down, you may not want to sell investments from your growth accounts. They are essentially on sale. In this case, you could choose to take your RMD from a more conservative account that you may have. This will allow your growth investments to recover and come back to where they were. Alternatively, if you have a sector that has had a big increase, you might decide to take your RMD from that account to reduce some of your risk. The key point though is for your IRAs, you can choose which accounts you take your RMDs from, but you must meet the total amount that's required for your RMDs. On to the sixth mistake. This is the opposite of what we just discussed for your IRAs. So pay particular attention to this mistake. If you have multiple 401k accounts or 403b accounts subject to RMDs, the aggregation rules are different. Unlike your IRAs, you cannot aggregate all of your 401k or 403 balances to calculate your required minimum distribution. Each 401k or 403b is subject to the RMD and must have its own separate distribution. You're required to calculate the RMD for each account individually and take the appropriate distribution from each one. This is an important distinction to keep in mind if you have multiple employer-sponsored retirement plans, which a lot of our clients do because they never rolled their 401ks into IRAs into retirement. So pay particular attention to that one. The seventh mistake is not understanding the still working exception for 401k RMDs. If you're still employed by the company sponsoring your 401k plan, then you may be able to delay taking RMDs from that specific account. However, there are a few important caveats to this rule. First, you must not be more than a 5% owner of the company. This exemption is designed for employees and not for company owners. Second, your 401k plan must allow for this provision. Not all plans are required to offer this option. So it's important to check with your plan administration to see if this is available to you. If both of these things are true and you still work for the company, then you can delay taking your RMDs out of that 401k account, even if you've reached the RMD age. It's important to note that this exception only applies to the 401k at your current employer. It doesn't apply to IRAs or for 401ks at previous employers. But if you do have other 401ks from previous employers, you can sometimes roll those in to your new current plan. The eighth mistake is not understanding the new rules for Roth 401k RMDs. Starting in 2024, with the passage of new legislation, Roth 401k accounts are no longer subject to RMDs. This is a significant change from the previous rules. Prior to 2024, if you had a Roth 401k, you were still required to take RMDs from that account, even though those distributions were generally tax-free. The Secure Act 2.0, which was passed in late 2022, eliminated this requirement. Now, Roth 401ks are treated similarly to Roth IRAs in terms of your RMDs. As you may know, Roth IRAs have never been subject to RMDs for the original account owner. However, it's important to note that different rules apply if you inherit a Roth IRA from someone else. Inherited Roth IRAs may still be subject to RMDs depending on the specific situations that you're in. But that's a topic for another video. But I wanted to mention that important point. The ninth mistake is simply forgetting to take your RMDs altogether. While this may seem like an obvious error, it's one that can have significant consequences. The IRS imposes penalties for failing to take RMDs as required. In the past, penalties for missing an RMD could be as high as 50% of the amount you were supposed to withdraw. For example, if your RMD for the year was supposed to be $10,000 and you failed to take it, you would owe a penalty of $5,000. You would also owe income taxes on the distribution. Fortunately, though, with the new legislation, the penalty has been reduced in recent years. The current penalty for missing an RMD is 25% of the amount you should have withdrawn. While this is still a substantial penalty, it's not as severe as it used to be. The IRS also states that if you correct the mistake and take the missed RMD before they discover the error, you may be able to reduce the penalty to 10%. Regardless of the specific penalty amount, it's clear that missing an RMD can be costly. To avoid this mistake, consider setting up automatic RMD withdrawals from your retirement accounts. Most financial institutions offer this service, making it easy to ensure you never miss an RMD. All right, the 10th and final mistake is not taking advantage of RMD planning opportunities. If you've reached RMD age, there are still strategies you can use to potentially lower your RMDs and reduce your tax liability. One such strategy is using a qualified longevity annuity contract. This is also called a QLAC. A QLAC is a special type of annuity that allows you to defer a portion of your RMDs to a later age, effectively reducing the amount of your RMDs in the meantime. Several rules and restrictions apply to those QLACs, so it's important to work with a financial professional to see if that strategy is right for you. Another important RMD planning opportunity involves charitable giving. If you want to give to charity or you're already giving to charity, you may be able to lower the tax impact of your RMDs by making qualified charitable distributions, otherwise known as QCDs. With a QCD, you can direct some or all of your RMD to a qualified charity, which then satisfies your RMD requirement, while also potentially reducing your taxable income. I'll be covering QCDs in more details in a future video, so be sure to subscribe to the channel if you're interested in learning more about that. In conclusion though, RMDs can be complex, but knowing these common mistakes can help you navigate this important part of retirement planning. Remember to start your RMDs on time, keep your spouse's RMD separate from your own, be mindful of the tax of delaying your first RMD. Also, understand the difference between RMDs and Roth conversions. If you found this information to be helpful, be sure to like and subscribe to this channel for more retirement planning insights. If you would like to learn more about working with our firm and how you can get your free retirement assessment, visit us at goodorfinancial.com/getting started. If you would like to learn more about Roth conversions while you're in your RMD years, then watch this video here to learn if you're too old for a Roth conversion.